All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the website at cubicleinvesting.com, and there you can download my free ebook that will teach you the basics of options trading. And also, if you download the free ebook, you will start to receive my weekly newsletter called the Cubicle Weekly Reader that comes out every Monday at 10 a.m. Eastern Standard Time, where we talk about, of course, the stock market, investing in general. And we also talk about cryptocurrencies from time to time. And from time to time, we don't give our recommendations because we can't give investment advice, but we do oftentimes share some investment ideas that we're actually looking at. So you definitely want to be a part of the Cubicle Weekly readership. So today is Friday, it's February the 10th. It's approximately 1:37 p.m. Eastern Standard Time. I know it's been a while since I made a video. It's been a couple of weeks. I've been rather busy, but I'm always trading nonetheless. So I got into this trade actually yesterday. I put on a vertical put credit spread. So as you can see here, I'm currently in a vertical put credit spread, right? For those folks who are unfamiliar with the world of options, I'm on the put side. So I have sold the strike price of 40.40 and I bought the strike price of 40.30. Considering that I sold the 40.40 strike price, which is closest to the price of the underlying, that makes it a vertical credit spread versus a vertical debit spread. Now, had I bought the 40.40 and sold the 40.30, then it would have been a vertical debit spread. But nonetheless, I put this trade, so the original trade was 40.75 and 40.65, but yesterday the price of the underlying in this case is SPX. This is what I, been primarily trading for the last, 7 to 8 months now. Although I have been trading, Microsoft, I do trade other underlines as well. But the one that I trade the most often is the SPX because it has daily expiration dates. Right, so I got into this trade yesterday. The price of the underlying started to test my vertical put credit spread, although it actually finished above the short structure. Had I stayed in it, I would have been okay. But nevertheless, I didn't want to risk it. So I rolled the strikes down from 40.75 and 40.65 down to what you see here, 40.40 and 40.30. And so the credit that I took in is $564. As you can see here, I've made 85% of that. So the unrealized. So if I actually were to close this trade out now, the realized profit would be 484. But right now, the unrealized profit is 484. I'm going to leave this position on until the expiration, until the close of the market today, which is 4:00 p.m. Eastern Standard Time. Because why? Well, as you can see here, the price of the underlying is actually, so SPX has actually pulled back 2 consecutive days. So Wednesday and Thursday, the market finished down, and so I figured, anytime I'm on the put side, and particularly if the market has been trending down, I'm much more confident about rolling on the put side versus the call side because the market has an upward bias, and also the market as of right now is actually improving, right? So the Federal Reserve is beginning to pull back on its interest rate hikes, and also there's a possibility they actually may halt their hiking of the interest rate come March the 22nd. So we'll see when the FOMC meets 22 March. So the environment is improving, although unemployment is still rather low, which is what the Federal Reserve does not want to see. They actually want to see the unemployment rates a lot higher, right? Because unless, if people are out of jobs, I mean, they have less money. So that means that demand for goods and services are going to go down, and that helps with the rate of inflation, right? But nevertheless, unemployment has been rather low. But that also means that the workforce is pretty strong. So again, having said all of that, I'm much comfortable rolling out on the put side versus the call side. So that's the reason why I actually rolled this position down yesterday and was pretty confident that this morning I will wake up, check the ES Mini, and discover that, the price of the ES Mini was trading above my short strike of 40.40 on the put side, and it was. Right, so I'm actually thinking about potentially putting on a trade on the call side as well. But as you can see here, the price is starting to pump just a tad bit, and I kind of expected a bounce today, considering that the market has been down 2 consecutive days, Wednesday and Thursday. So I kind of expected a bounce. Yeah, but nevertheless, I may just stick with this position on the put side. But come 3 o'clock, I'll see how much meat is still left in the bone, and so I may just decide to put on a vertical call credit spread where I sell the same number of contracts for, and it does not require any additional capital to put on that vertical call credit spread, because at that point you will be turning the position into an iron condor, which basically is a vertical call and also a vertical put credit spread. But nevertheless, I'll update you guys right before the market closes. Again, it's 1:42 p.m. Eastern Standard Time. So I'm pretty confident that I'll walk away with the entire $564 here. So as I mentioned before in several videos, I'm always looking to get at least between $300 to $500 per trade on a daily basis. Doesn't always happen, but you got to start out with a goal, right? You got to start out with a goal. All right, I'm back. My mic on here. So I think it's safe to say that my trade is going to work out. It's approximately 3:26 p.m. Eastern Standard Time. So pretty much safe to say that I'll be walking away with the entire $564. You can see I've already made the full credit there. Just haven't realized it yet until I actually close it out or the market closes. But one of the things I wanted to mention before I end this video is that and I mentioned this before, but so just some of the information that I maintain as part of my market awareness is annotating or making a notation of the closing price every day. So the SPX's closing price every day, and also what the expected move is at close. So in other words, when the market closes today, what is the expected move at close for tomorrow, for tomorrow's expiration date? And so the reason why I like the expected move at close is because if you wait until tomorrow, right before the market opens, then the expected move actually changes quite often. So to me, from my perspective, the expected move at close, meaning that when the market closes today, what's the expected move for Monday? I'm sorry, not tomorrow, but for Monday, since today is Friday. What is the expected move for Monday? And so to me, that's the most accurate EM or expected move. And so I look at the expected move at close, and then what's 1 times the expected move up and down, right? So 1 time the expected move up, 1 time the expected move down, and also 2 times the expected move up or down. And then the other thing I like to look at as well is the percent change from day to day on the SPX, right? Because that gives me, for example, like the last 2 days, the SPX has pulled back, and so the reason why I was really comfortable with rolling my position out that I put on yesterday, rolling out for today's expiration date, is because the market has been down 2 consecutive days. So can it be down 3 consecutive days? Absolutely, but how far is it going to pull back? Considering that it's already been down 2 consecutive days, and also to add to that, the market environment is actually improving, right? So that's the reason why I felt comfortable rolling on the put side. And again, because the market has an upward bias, right? So the market's been down 2 consecutive days. You're already on the put side. Just roll down further if your vertical put spread is being tested. And also, as you can see here, not much not much change throughout the day, you know. So again, because and probably Monday, we're probably going to see, you know, a nice bounce on Monday, you know, because this will make the third consecutive day that the market has finished in the negative, assuming that it's going to be a negative close come 4 o'clock. You know, so it might actually end up finishing in the green. As you can see here now, the market is pumping a little bit, you know, and that's very, you know, characteristic of the market within the last, you know, hour, 30 minutes. You know, the market, particularly in a bullish market, you'll see more buying taking place within the last hour. And in the bearish market, you'll see more selling taking place in the last hour, you know, so. But yeah, so hopefully that information is helpful.